Rick Santelli is standing by. He's got some breaking economic data. Rick, take it away.
Yes, we are awaiting the GDP. This, of course, is our second time around the block, our second look at third quarter GDP. There still can be some changes. While the wires are hitting the trade balance first. On trade, we're expecting minus $86.5 billion. We end up with minus $89.8 billion, minus $89.8 billion. That is the biggest deficit going back to July when it was minus $90 billion. On the GDP, we're looking for 5%. Upgrade that, 5.2. That's actually a rather healthy revision. 5.2. It still makes it the best quarter going back to the last quarter of 2021. On the consumption side, we lose a little bit. 3.6. We're expecting it to remain at 4%. But as I said, 3.6. Now, if you look at the price component there on consumption, or price component, it is 3.6. That is 1/10 hotter than our last look. And that is significant, 3.6, because we want to continue to see, of course, these numbers remain under pressure. And also, when compared to the last quarter, it was 1.7. So 1.7 was the smallest going back to the second quarter of 2020. It popped up to 3.5. Now you add an extra 10 to 3.6. If you look at the core component of that price index on a quarter-over-quarter basis, it went in the other direction. It was down a tenth. Instead of 2.4, it is 2.3. And 2.3, of course, is the smallest going back to the last quarter of 2020 when it was 1.8. We forgot a couple of things we want to make sure that we hit on. If you're looking at wholesale inventories, they were down 0.2. What's notable here is that means that 8 out of the 10 months of this year have been negative months on wholesale inventories. That's something to pay attention to, especially going into the holiday season, knowing that inventory levels have made big adjustments over the years and supply chain issues. Finally, on the retail inventory front, expecting a nice pop up 0.6. Wasn't meant to be unchanged, but we did get a revision last month, also in the wrong direction, from up 0.9 to only up 0.4. Zero on that inventory number would be the lightest read that we've had going back to, that goes back quite a ways. We're going to have to go back to November of last year when it was minus 0.2. Now, let's synthesize all of that, of course. Better growth, split decision on inflation. Core may be more important to many observers, and that was down 0.1 versus the price index up 0.1. We see that interest rates are under a little bit of pressure after that number, and the pre-opening equities have remained very healthy. You added a few points on Dow futures, but to be fair, we had a big downdraft in rates not only today and yesterday that this is pushing into, and even a bad auction yesterday on the 7-year couldn't stop that march of rates lower. We touched 4.25 today. Should we close at current levels, Joe and Becky, it would be the lowest yield close basically since mid-September, and that would be true for 10s, 30s, and even 7-year. Shorter maturities, of course, a bit longer comp.
What's the quickest economic turnaround in history? Why the hell would we get rate cuts in the first quarter of next year with a 5.2% print on GDP? I'd have to turn around quicker than a 10-year.
Yeah, Joe, on the growth side, I have suspicions there, but let's take it at face value.
You don't believe the 5.2?
No, I really don't believe the 5.2, and I can't give you exact reasons. I'm just being honest with you. I think it's a bit exaggerated there, and I also think that there's some issues, of course, that are post-COVID, post-supply chain, that have made distortions. But I do think that what you want to pay attention to is, even though we've made progress on some of the inflationary numbers, many of them are still well above the 2% target, and that is all that really should matter to the Federal Reserve at this point.
Rick, thank you. Steve Liesman joins us right now with more on this. Steve, what are you thinking?
Well, I'm thinking that if you're going to get an upward revision to GDP in a world where we're worried about too much growth, this is the way to do it. If you notice what Rick said, he told us that GDP was revised higher, but the inflation number was revised lower. That means that there was more real growth. It also tells you there was more productivity in the economy. That's just one of the debates going on among Fed officials, whether or not we've had this surge in productivity the last 2 quarters. Does it remain around? Is it something they can rely upon for policy? Because obviously if we do more with what we got, it's less inflationary. That's one. Two is you had an upward revision to the savings rate. That was a good number there, up to 4% now, up a couple tenths. So that's a positive development. Whether or not, and I think Joe was getting at this, the slowdown is really the story here. And right now it's all anecdotal. I'm here at the CFO Council, and I'm hearing really mixed results. Some companies are doing quite well, and they're seeing things progress into the fourth quarter and into next year. Others are more concerned and having a bit of a tougher time right now when it comes to the outlook for their businesses. So, and we have Barkin coming up from the Richmond Fed at 9:55 this morning. And the story with him is he's been one of the Fed officials relying more upon anecdote than the actual data. And I think Joe's question is a good one. How much will we slow is really the question the Fed is going to ask. One more thing, which is the big debate in the markets this morning is, did Waller mean to say what he said? When he said, hey, it's logical we would have cuts next year, you'll remember that Powell ducked on that question. He wouldn't answer it. I asked Collins and Mester last week about it. They wouldn't answer it. Waller went right after it. Was it an intentional? Was he sent out there to ease financial conditions? In any event, look at those probabilities. Now a 77% probability for a cut in May, and they're starting to think about and romance March for a possible cut. And, of course, what's happened to the 2-year is pretty important. I think we were down over 20 basis points over the last couple of days. I didn't get to look at it right now to see if it's still out there. It still is 467. So, guys, things are moving right now, and there's a lot of questions about the outlook that maybe we'll get some answers here at the CFO Council.